Your Royal Highness, ladies and gentlemen, I'm here this evening by accident, not at this convening, but I mean in finance. When I went to university many years ago now, I went to be a teacher. And unfortunately, halfway through my education, my university disbanded the education department. So I looked around for a discipline that was closest to education, and I found child psychology, which incidentally has proven to be the most effective discipline to manage investment bankers and investment managers I could possibly have imagined. In any event, when it came time to graduate, I realized I needed to find something to do, so I applied to get my doctorate in psychology. I was rejected. Then I thought, well, I'll volunteer for the Peace Corps. I was rejected there too. That's a volunteer assignment, I'd note. Afraid that I was coming home, my father suggested I try banking. So I applied to 70 banks in 1981 in the United States of America, and was rejected by 69 of them, but did get one yes, and that has started my career in finance. Now, I think we all would agree today of a paraphrase of Winston Churchill, that capitalism is the worst economic system except for all the others. Capitalism has great strengths, and it's at the foundation of every successful economy in the world today. And to be clear, I'm a capitalist. As it happens, there are not that many socialists at Goldman Sachs, so that's probably not a surprise to you. But there are serious flaws in capitalism. Among them includes the rising inequality, the focus on the short term, misaligned and outsized incentive structures, failing to price externalities like global warming pollution, and an over-reliance on measures of growth, GDP, that actually doesn't measure the most important parts of our society, like the health of our communities. Moreover, the stark reality is that the challenges facing the planet today are unprecedented and extraordinary. Climate change, water scarcity, poverty, demographic shifts, and a global economy in a constant state of dramatic volatility and flux, to name but a few. And these issues are linked. Clearly, governments and civil society will need to be a part of the solution to these massive challenges. But ultimately, it will be companies and investors that mobilize the capital needed to overcome them. Now, my business partner, Al Gore, and yes, it is true, he wanted to call the firm Blood and Gore, likes to say he's a recovering politician on about stage 9. Yet I've never considered myself a recovering investment banker. Call me naive, but when I started in finance 30 years ago plus, I didn't think I'd have to check my values at the door. I believed then, as I believe now, that finance can be a force for good. So can I offer you any other reason than it's the right thing to do to consider sustainability? Yes, absolutely yes. First, on a macroeconomic basis, by fully recognizing both positive and negative externalities, our economies will more effectively allocate capital, which will lead to stronger, long-term economic growth. And the challenges that I outlined above can be resolved. And secondly, more poignant for us here today, asset managers and asset owners, 2 words, return and risk. In fact, the investment case for sustainability is robust. There's 4 points. First, the ESG matrices allow companies to achieve higher compliance standards, better manage risk because they have a more holistic understanding of the issues that affect their business. This is also about reputation, brand, and license to operate. Secondly, companies can improve profitability by reducing waste, increasing energy efficiency, and by improving human capital management strategies that ultimately results in lower employee turnover. Most interestingly, frankly, businesses that can address the challenges of sustainability through their products and services can drive revenues, profitability, and competitive positioning. And lastly, sustainable businesses realize financial benefits such as lower cost of debt and lower capital constraints. 10 years ago, when I announced to my partners that I was retiring to set up a sustainable investing firm, which most of my partners said, "This proves what we already knew about you, you're crazy." But 10 years on, the conversation around sustainability has come a long ways. There's now something in the order of between $30 and $40 trillion of investors who've signed up for the principles of responsible investing. And most importantly, the business case for sustainability is clear and it's robust. Our commitment to integrating sustainability into the investment process has never been a feel-good exercise. It's never been to express our values in the portfolio. We are not trading value for values. It's a tool, it's a better lens to help us make investment decisions. It's about creating long-term value for our clients. Now, we typically do not like to talk about investment performance because it's the property of our clients, and it's been my experience over the years that as soon as a fund manager begins to boast about their performance declines. However, to try to make our case a little bit more clearly and strongly, we've been at it now about 8.5 years, and I know the statisticians among you will say that that doesn't yet prove skill, but we're getting closer. We told our clients that we hoped that we would outperform by between 300 and 400 basis points per year. We've exceeded that since we started. It's also worth noting that sustainable investing strategies can be employed and deployed in private equity, growth equity, fixed income, real estate, forestry, and agriculture across all the asset classes. So to conclude, those who advocate sustainable capitalism are often challenged to spell out why sustainability adds value. Yet the question that I think should be asked instead is, does an absence of sustainability damage companies, investors, and society at large? From BP to Lehman Brothers, there's a long list of examples that proves that it does. Thank you.